Stock exchanging is a process of buying and selling stocks to benefit from day-by-day stock value changes. So, if you want to know about the top 5 stocks to buy, you've come to the right place. Welcome to Upstep Financial. Today we bring you a more informative topic, so don't forget to subscribe to our channel for more up-to-date content. Just one click on the bell icon and stay with us. Putting investments into stocks can help you earn a couple of cent stocks in minutes, hours, days, or months. Moreover, beneficial stock trading will help you acquire and limit the danger of losing. Today, we will be counting the top 5 stocks to buy now. The first stock we'll be looking at is Well Health Technologies Corp. This is one of the best stocks to buy now. The stock itself has had some pretty choppy trading over the past year, with significant levels of volatility above some resistance in the high $6 range. Following the major run-up that it experienced in the second half of 2020, it is considered that telehealth peers such as TDOC in the US have sold off more than 50% from all-time highs. Well Health is faring quite nicely and from an underlying growth standpoint has been hitting top-line growth out of the park. Most recently, though, Q2 figures were astronomical with record quarterly revenues of $61.8 million, representing growth of 484% year over year. This growth mainly resulted from a 432% increase in their virtual services revenue, which is what we would want to see from a company such as this one. Gross profit also increased substantially by $615 year over year, with the most recent gross margins hitting just shy of 50%. This is coincidentally also the company's third consecutive quarter of positive EBITDA at $11.9 million for the quarter. So even though Well Health has continued burning through staggering amounts of cash and posting negative earnings figures, I still like what I'm seeing in terms of the aggressive expansion strategy that they've deployed. This is leading to monumental top-line growth figures despite the company's current price-to-sales ratio. It does remain quite pricey in the big picture. Okay, guys, moving on to the second stock that I'm keeping my eye on all the time, Granite Construction Inc. Granite Construction Inc. has a Canada-based REIT ticker symbol, GRT, and is an industrial real estate investment trust. This is a stock that continues to impress me not only from its consistent growth and appreciation in share price, but also from its nice dividend yield of 3.26%. Most recently, Granite REIT had posted their Q2 figures, along with the news that they've acquired 3 new income properties and a development property in the United States for a combined purchase price of $198 million. Nice performance across the board in this quarter's finances. The company's net operating income sits at $80.3 million, which represents a growth of 12.8% year over year. We're not going to necessarily see increases in that operating income or top line as we saw in tech stocks. This is a company that is growing a lot slower. However, it is more consistent in this growth. Their funds from operation is a metric for the financial viability of a REIT. It also exceeded my expectations at $62.2 million, up roughly 20% since Q2 2020. I'd also like to address the fact that since Granite is an industrial REIT, their finances were not really affected throughout the pandemic. In fact, they have never missed any payments whatsoever in the rental collection. They've collected 100% of their payments throughout the pandemic. This is a fair comparison to make from 1 year prior. Now, in terms of their property portfolio, we're looking at fair market value appreciation that has absolutely skyrocketed over the past year with an appreciation of around $300 million in the second quarter alone. This is a company that owns a massive amount of real estate. Due to the real estate boom over the last year and a half, their properties have also increased in market value. GRT's fair market value for its assets has now exceeded $6.4 billion. They've also managed to reduce their overall debt levels. Finally, Granite has a long history of leasing out quite a large portion of their overall leasable area. So Granite REIT is trading at all-time high growth. All right, friends, I hope you are enjoying the video. If so, don't forget to subscribe to the channel Upstep Financial and stay with us. If you have any questions regarding stocks, tell us in the comment below. We are now moving on to stock number 3, Corsair Gaming Inc. Stock Corsair was recently caught up in a Wall Street bets rally. Over the past month, the company released its earnings for the quarter ending on June 30th, 2021, which showed some slower than expected growth, which also contributed to the toppling share price. But despite the slower than expected growth, we're still looking at $473 million in top line for this quarter, which year over year represents an increase of 25%. Considering that last year in Q2 there was a significant increase in demand resulting from the pandemic. 25% growth is actually great to see. We should also keep in mind that this is a type of company that experiences cyclical sales, where Q3 and Q4 are always going to be their best quarters as it's gearing up for the holiday season. What is a bit more concerning for Corsair, though, is supply chain issues resulting from problems such as the unavailability of semiconductors at the moment. Overall, rising costs are digging a bit into this company's gross profit margins. Nonetheless, the company is focused on paying down its outstanding debt by an additional $25 million this past quarter. In the past year alone, Corsair has reduced its overall debts by 45%. Since this past quarter was profitable for Corsair, I believe that the negative price action we've been seeing is unwarranted. This is a growing company that's increasing its financials in all the right places. They've also launched many new products in the first half of the year. All the new products are aimed at gaming and streaming, which are massively growing industries. In fact, ARK Investments are projecting substantial increases in video game consumption over the next 5 years, with a projected 21% compounded annual growth. Of course, Corsair isn't really a company that produces video games themselves. Let's now talk about the fourth stock, Facebook Inc. Facebook, with the stock ticker symbol FB, really needs no introduction. They're the world-leading social media platform that owns several other companies. They currently have over 3.5 billion active users across their platforms, a year-over-year increase of 12%. Just think of that for a second, though. 3.5 billion monthly active users across their platforms is nearly half of the entire world's population. And this is going to continue to grow as more individuals gain access to the internet. Currently, the stock is trading at all-time highs. However, consider their underlying levels of financial growth. The relative price-earnings ratio is right in line with what it's been since 2017. In fact, we can see that their earnings per share have really taken off since early 2020. The same thing applies to their price to sales and price to free cash flow figures. Nothing out of the ordinary since 2017. This past quarter was fantastic, with total revenues of $29 billion, which is an increase by 56%. Their income from operations has more than doubled. In fact, their operating margin has also increased by over 10 points, and net income has more than doubled. Facebook truly is a digital advertising powerhouse with a massive amount of momentum. Now, interestingly, Facebook's CFO is stating that they're projecting year-over-year total revenue growth rates to decelerate in the second half of 2021. This is quite a surprise because usually Q3 and Q4 are the best quarters for a company such as this one, which relies primarily on digital advertising revenue. This rationale is due to lap periods of increasing growth resulting from the pandemic. Facebook's financial position is always stellar. They have a current ratio of 5.43 with over $64 billion in cash equivalents. Finally, Mark Zuckerberg has recently been speaking about a sort of a metaverse that they're looking to create, and I'm extremely excited about this. All right, moving into the last stock, Amazon.com. As one of the biggest companies on earth, Amazon has proven its uncanny ability to post spectacular growth rates despite its size, making it a natural member of 2021's best growth stocks to buy. For many years, Amazon denied itself profitability, choosing instead to expand its market share through razor-thin margins while plowing every dollar back into long-term investments. In 2021, AMZN remains a glorious tale of margin expansion combined with rapid top-line growth. Its international business just turned profitable in 2020, and for a company with $419 billion in trailing sales, Amazon's 44% growth rate last quarter is spectacular. In addition, AMZN is still looking to disrupt other parts of the economy, reportedly planning its own primary healthcare services business that it will offer to large employers. With healthcare spending accounting for more than 17% of the U.S. economy, Amazon has its eyes on the prize. So, these were the top 5 best growth stocks worth investing in now. Make sure to leave a like and subscribe so you can join the Upstep Financial Squad and be part of the channel. Thanks for watching the video. Bye!